Welcome back to Investing Talk Podcast.
Today we're looking at coals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it. I think with coals, the big question for a lot of people is, what's the story here? Is it just another struggling retailer?
Well, that's the thing. On the surface, it seems that way. And for a long time, it was. But if you dig a little deeper, especially into the last quarter, you start to see signs of a real financial inflection point.
An inflection point, despite all the headwinds in retail.
Exactly. Despite those headwinds. For a while, Kohl's was kind of seen as a laggard, right? Caught in that tough middle ground.
And the top-line numbers still justify that fear, I think. That's the primary concern for any investor looking at this.
It is. The sales decline is the big number everyone points to.
Let's put some figures on that.
Yeah.
For the first 9 months of this fiscal year, revenue was, just over $11 billion?
Yeah, $11,019 million to be exact, and that's down from $11,452 million the year before.
So that's a drop of about 3.8%. And management isn't even hiding from it. They're projecting full-year sales to be down between 3.5% and 4%.
Right, and when the market sees that, the immediate reaction is, stagnation. They just move on. But the real story, what we're looking at today, isn't about top-line growth, is it?
Not at all. The investment thesis right now is all about control. It's about efficiency and leverage. The entire positive story is operational, and it's kind of buried in the income statement.
Okay, so let's unpack that. If they're losing almost 4% in sales, where are they making it up?
They're winning on margins and on cost control. The single most important number from their last report was the gross margin expansion in Q3.
Right. It jumped by 51 basis points, hitting 39.6%.
Yeah. And I want to pause on that because, for anyone who doesn't track these metrics daily, 51 basis points might sound tiny. It sounds like almost nothing, right?
But it's so critical. It's pure profitability leverage. It's half a penny more profit on every single dollar they sell, and they did that while sales were shrinking.
Which proves the cost structure is being managed separately from just, getting people in the door.
It proves that they have control. So the question is, how did they do it?
Well, it's easy to say better inventory management, but what does that actually mean?
It's about a few things happening at once. First, they've been improving their merchandise mix. They're pushing more exclusive products that just have better pricing power.
Okay, so less reliance on generic brands.
Yes. And second, and this is the real nugget, they're using data much better to avoid overstocking on seasonal stuff.
So they're not left with a mountain of winter coats in April that they have to sell for pennies on the dollar.
Precisely. That minimizes those huge margin-killing discounts at the end of the season. They're just getting smarter with their buying.
Buying better, clearing out less. And they're pairing that with really tight expense control. I saw the SG&A numbers. Selling, general, and admin expenses fell 2.1% in Q3.
Which is super impressive because with inflation and wages and everything else, cutting your overhead is a huge challenge. It shows real discipline.
And when you put those two things together, the margin expansion and the cost control, you get this kind of explosive operating leverage.
And that leverage is what led to the huge market reaction after the Q3 report. Their operating income was $77 million. That might not sound like a lot, but the street was expecting something flat or even negative.
So it was a massive beat.
A huge beat. And that gave management the confidence to substantially raise their full-year guidance. And that's really the cornerstone of this whole bullish argument.
Let's talk about that guidance because it was pretty dramatic. The adjusted operating margin forecast, they lifted that from a range of 2.5 to 2.7%, all the way up to 3.1 to 3.2.
A big jump. But the real shocker was the EPS guidance, the earnings per share.
They almost doubled it.
It almost doubled it. It went from a range of 50 to 80 cents and shot all the way up to $1.25 to $1.45.
When a company doubles its profit forecast mid-year, that sends a very strong signal. It means the changes they're making are working faster and better than even they expected.
It signals that all those savings from fewer discounts and tighter overhead are just dropping directly to the bottom line. It's not getting eaten up somewhere else.
And on top of all that, the company's financial position is actually pretty solid.
It is. We have to talk about their resilience. They ended Q3 with $144 million in cash, and their total shareholder equity is at $3.93 billion.
That equity number is important. It gives them a lot of flexibility. Plus, they're generating serious cash from operations.
Absolutely. Net cash from operating activities was $630 million year-to-date through November.
Which is more than enough to cover their planned capital expenditures, right? That's about $400 million for store updates in tech.
Comfortably. And, crucially, it supports their dividend.
Yeah, that quarterly dividend of 12.5 cents a share. The fact that they reaffirmed that tells you management believes this cash flow is stable, it's sustainable.
It's a huge vote of confidence from inside the company. And they need that financial strength because, let's be honest, retail is a brutal sector. Their whole model is based on that value proposition and their exclusive partnerships, like with Sephora. That kind of shields them from the deep discounters on one end and the premium chains on the other.
Okay, so the fundamentals look surprisingly strong. The turnaround seems to be taking hold. The next question is the market buying it? Are traders believing this story?
They are now. If we look at the charts, we've seen a really strong technical reversal.
The stock hit a low back in September, didn't it? Around 1275.
It did. And since then, it has just consistently been making higher lows. It broke through resistance at $15, and now it's testing $16.
And we're seeing the classic bullish signals that go along with a move like that.
Textbook bullish movement. The stock is trading above both its 50-day and its 200-day moving averages.
That's the Golden Cross setup.
A Golden Cross-like event happened in early November, yeah. That's a classic sign that a short-term uptrend could be turning into a longer-term bull phase.
The momentum indicators, like the RSI, are they confirming this?
They are. The relative strength index is sitting in the mid-60s. And that's significant because it shows buying pressure is strong, but there's still room to run before it gets into that, technically overbought territory above 70.
I see. And what about the MACD?
The moving average convergence divergence. That's also positive, and it's rising. It confirms the momentum is real. It's not just a one-day spike.
So the charts are lining up with the fundamentals.
And, maybe most importantly, we're seeing institutional ownership patterns start to shift. After a long time of big fund selling, we're now seeing renewed accumulation in Q4. The big money is starting to believe the story.
That's a powerful combination. It probably helps that there was a leadership change recently, too.
For sure. Michael J. Bender was appointed CEO on November 24th. Fresh leadership for what's going to be a really crucial execution phase.
Okay, so looking ahead, the next few months seem packed with catalysts.
Absolutely. The coming 3 months will either validate this whole thesis or derail it.
First up, and probably the most important, is the holiday season sales update. That should be coming around December 11th.
And that will be our first real test. Did their new inventory and promotion strategies actually work with shoppers during the busiest time of the year?
If they post good holiday numbers, that would set them up perfectly for the full Q4 earnings release.
Right, which is expected near the end of February. Given how disciplined they've been with inventory, the setup for a holiday-driven beat on the bottom line looks pretty strong.
We should probably mention those capital market events in January, too, the ETF rebalancing and all that.
Yeah, those can cause some short-term volatility. When big funds have to adjust their holdings, it can definitely amplify moves in the stock, for better or worse.
And looking a bit further out, what's the longer-term potential here?
Beyond the next quarter, it's all about scaling those strategic alliances. The Amazon Returns program, the Sephora shops, those things drive foot traffic. Now they have to prove they can convert that traffic into sustainable revenue.
There's also always some speculative chatter around a company like this when it starts to show signs of life.
Oh, always. Right now, there's unconfirmed talk about them exploring expanded home goods sections or even value-oriented grocery partnerships in some stores.
Now, we should be clear, that's just a rumor.
Strictly a rumor. But let's just think about it for a second. If they could pull off a grocery offering, even in a small number of stores, think about the traffic that drives.
People buy groceries way more often than they buy clothes.
Exactly. It would create a structural, high-frequency reason for people to come into the store. That could be a huge tailwind for margins starting in fiscal 2026.
It's a fascinating idea, but the execution risk on something like that would be massive. You're basically starting a whole new business.
Oh, absolutely. And that brings us to the core risks that are still here. But the market also hears the other perennial buzz, M&A interest.
Private equity, right. With the stock price still relatively low and a big real estate portfolio, there are always whispers.
And activist investors are never far behind, pushing for things like asset monetization.
That's where that $3.9 billion in shareholder equity really comes into play.
Yeah.
It suggests there's real value there, maybe through sale-leaseback deals on their stores.
Right. And while that's all just speculation for now, it does offer a potential upside that isn't really priced into the stock today.
Okay, but let's ground ourselves back in the main risks. What's the biggest hurdle they face?
I'd say the execution risk is number one. They have to keep nailing the merchandise mix. They have to keep improving how people see the brand. If their Q4 promotions end up being too aggressive or the new products don't sell, these margin gains could just disappear.
And they're still at the mercy of the wider economy, right?
Of course. The whole retail sector is. Kohl's is very sensitive to consumer confidence. If people get scared about a recession and stop spending on discretionary items, Kohl's is going to feel that pain.
But I think what's different now, what makes this interesting, is that they've shown they can protect their bottom line through cost control. They've built a buffer.
They have. The whole story has shifted from are they going to survive to how successful can this turnaround be?
So the final thesis is really about that combination of stabilizing fundamentals, that margin leverage, lining up with a very bullish technical chart.
Exactly. The foundation is there for potential value realization over the next year or two, especially if this all-important fourth quarter meets or beats these new higher expectations.
I think the real question for me isn't just about Q4. It's whether they can finally convince the market that their position kind of sucked between Target and Macy's is actually a viable place to be for the next decade.
That's the billion-dollar question. If they can't convert all that foot traffic from Amazon returns into loyal, repeat Kohl's shoppers, then these impressive margin gains might end up being just a fantastic but temporary flicker.
Definitely want to watch it closely.
Absolutely. Make sure you subscribe to keep up with our future analysis, especially as we get closer to those crucial Q4 earnings in February.